Good day, welcome to today's class. If this is your first time on this channel, please click the red subscription button to subscribe to my YouTube channel so that when we drop more videos, you will get notified. So for the sake of this class, we'll be treating company income tax. We are just starting the topic afresh and there are a lot of things we are going to talk about. But before we delve into company income taxes, so we need to define the types of company. According to Acca in Nigeria, we have three types of company. First, we have the small company, we have the medium company, and we have the large company. Yes, we have the small company, we have the medium, and we have the large. Now, when do we say a company is small? A company is small when their turnover is less than, in a year, their turnover is less than 25 million. So if their turnover is less than 25 million naira in a year, that means that from January to December, or from whatever date they have peaked, from the beginning of their account to the end of their account, they were not able to make sales that is up to 25 million naira. We call them small companies, and they attract their tax 0%. Their tax rate is 0%. That means that a small companies don't pay company income tax. So we have the medium companies. That means that company that earn on their turnover is greater than 25 million, but it is less than 100 million. Their profit, their profit is greater than 25 million and it is less than 100 million. Don't mind me, let me just put it that way. So medium company is a company that earns, or the total turnover in a year accounting period is greater than 25 million, meanwhile it is less than 100 million. And this set of companies attracts 20% tax rate, CIT rate. So the rate of taxation for medium companies is 20%, while large companies are companies that earn anything above 100 million. So any company that earn anything above 100 million, they attract 30% tax rate. So according to Acca in Nigeria, these are the three kinds or three sets of companies we have. Another thing I'll be talking about that are very, very important. I'm not going to take the theoretical aspect most. I'm only explaining the theoretical aspect that we are going to need when we start solving. So I believe you can read the theoretical aspect yourself and get it, but the major ones I will highlight them in this video, so follow. Now, so another one we talk about the basis of assessment. Yes, what do we mean by the basis of assessment? If you have not watched out my video on basis of assessment, please watch it out. So company income tax use what we call preceding year basis. What do you mean by preceding year basis? I already told you that preceding year basis means that the tax of 2020 will be collected in 2021, the tax of 2021 will be collected in 2022, and so on. And why is it like that? It is like that because, let me give you guys a good scenario that will explain why it is like that. You know, a company prepare their account for good 12 months, that is January till December. Let me use January to December. So in the year 2020, our accounting year runs from January to December. So we are just still in, let's say, September 2020, and government is now coming that same 2020 to collect tax of 2020. How? Because it is when we finish or we end our accounting year, we will calculate, we will now determine our profit. It is from our profit government will tax. So if government is coming September or mid of 2020 to come and collect tax of 2020, there's no how we can be able to get it because we have not finished our accounting year and we cannot estimate our profits. That is why in company income tax we use preceding year basis. So another aspect that we'll be talking about is the we call it non-taxable income. Yes, non-taxable income of companies and disallowable expenses. So I said the next thing we'll be talking about is non-taxable income and disallowable expenses. Firstly, what do you mean by non-taxable income? Let me give you guys this. You see, okay, even before that, when we say non-taxable income are income that we don't tax. Yes, companies, as a company, you might have more than a source of income. You know, as a company might probably be running or be doing trade, and at the same time invest in some other companies. It is possible. So there are some income that we don't tax them. So if the company classify them as income, as tax authorities we remove them. So we need to know those set of incomes, and they are what we call disallowable expenses. What do we mean by disallowable expenses? That means that expenses that are not meant to be subtracted from the profits. Yes, there are some expenses that governments or tax authorities, in tax generally, we don't allow them to be subtracted from their profits. Yeah, I will give you an example. Unless when dealing with, I'll move a little bit to financial accounting to explain the concept of what I'm trying to explain. In financial accounting, let's use, okay, when you have your gross profit like this, you have your gross profit, let's say like this. From your financial accounting knowledge, you should be able to get that. Then you less all your expenses, less expenses. So part of your expenses will be, let's say, salaries and wages. Salaries and wages. Another one can be donations. Donations, yeah, it's possible. Another expenses we can have might be depreciation and so on. So let me just stop on this theory. Then we add all our expenses together, we subtract it from our gross profit, and that will give us our net profit. So what you will be given, or what you need, is your net profit. Whenever you are being given a question on asking you to calculate the company income tax, you need to adjust. What do I mean by we need to adjust? Yeah, look at these donations now and depreciation. In tax, they are disallowable expenses. We don't allow them to be subtracted from the profit. There are reasons, and I will explain. But if you take this profit now, but what you'll be given rather is this profit. This profit is what you'll be given. So you will take this profit from your net profit. You say your profit, this is what you will do. Your profit, you will take your profit. This is your final answer. This is their profit, and that is what you are using. So your profit, you will now add disallowable expenses. Disallowable expenses. I'm just giving you the brief format. So disallowable expenses include donations. I've not explained why they are not allowed, and I will explain. Just follow. Donations and depreciation. Depreciation. So you will add them. Why? Because they are not allowed to be subtracted. So you add them. So whenever you take, if you want to solve, you start with the profits, you add disallowable expenses, and you will less non-taxable income. Yeah, non-taxable income might be maybe part of this gross profit. You have investments. Part of this gross profit, you have investment. So investment too is a non-taxable income. I will explain how we are. Is a why did I put it here? Sorry. Yeah, non-taxable income rather. So, and I will explain why it is a non-taxable income. Just follow this video. So if you have your investment that has been added to your profit, it has increased your profits, right? So what do? You less it. If you have non-taxable income, that means that disallowable expenses. Sorry, I'm mixing those things together. If you have disallowable expenses that they are not allowed to be deducted, but it has been deducted in the financial accounting, what do? It has been deducted. The effect is that it's going to reduce your profits, and since they are not allowed, what do? You add them back. So you add disallowable expenses, and if you have non-taxable income, what does non-taxable income do to the profits? It will increase the profits, and they are not to be taxed. So what do? If you have non-taxable income, you less non-taxable income. So when you get the total of this, you now say less non-taxable income, which is investments. I hope you are following. Investments, then you less non-taxable income, then whatever you now get is now your taxable income. So now, but what I want to dwell on is how can you know disallowable expenses and non-taxable income? How do you identify them? That is the main question. Now, so as I was saying, I said, how do you identify non-taxable income and disallowable expenses in every question if you are being given? So let me start with this. disallowable expenses, disallowable expenses, and non-taxable income. Non-taxable income. So how do you identify them? For you to identify this set of income and expenses that will fall under these two, you need to know this. We call it WREN. 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 Now, what does this WREN stand for? This W stands for wholly, reasonably, exclusively, the E, exclusively and necessarily. Now, I said, what's the full meaning of this WREN start from? And before, if you understand this WREN very, very well, you'll be able to identify disallowable expenses and non-taxable income when you see one in every question. Now, the W starts from wholly, R stands for reasonably, E stands for exclusively, and N stands for necessary. That means that, you see, the trick behind this thing is that any expenses you want to classify as expenses that will be deductible, or expenses that is allowed, or expenses that are allowed for subtraction, are expenses that are wholly, reasonably, exclusively, and necessarily incurred in production. For example, now I will take few examples of disallowable expenses and few examples of non-taxable income. So few examples of disallowable expenses is donations. Yeah, let me start with donations. Now look at donation. Now donation is a disallowable expenses. Why? Because when you are doing trade, is not donation is not an expenses that you need to incur for production to happen. No, that means that even if I did not donate, this donation is just part of my own willingness something. The only expenses that you allow are expenses that if I don't incur them, it will have effect on my production. Yeah, if I don't pay salaries and wages, my workers will stop working. I will not be able to get my products. If I don't pay rent, I will not be able to use. So all these expenses that they are very, very, very important for production to take place, they are the allowable expenses. But expenses that they are not important for the production to take place, you just did it out of your own willingness. Example is donation. Yes, at some point, now there's an exception rather for donation. If you are donating to, as business organization, you are donating to recognized bodies. Yeah, you are donating to universities or club or associations that are recognized by the government and are registered, it will be allowed. But in your statement, you are just putting donation to one club that we don't even know, that is not even registered. We will not allow it. And if they are being donate if they are donating if the company is donating to registered company, it will be stated in the question. Maybe they are donating to NGO, they are donating to, yes, they are registered and well recognized by the government, it will be allowed. Another expenses that is not allowed is depreciation. I know you will be like, depreciation is also, should be, I know you'll be confused that depreciation should be a allowable expenses, but I'll tell you why it is not allowed. And that is why you need to watch my video on capital allowance. I will explain, but not in details, but you need to go and watch my video on capital allowance. You understand why depreciation is not is disallowable expenses. And the reason is just simple. The reason is that, you see, when we talk about depreciation is just like loss in value of assets. And for any assets business organizations are buying, any assets companies are buying, government will give them allowance. What did I mean by allowance? That means that if I'm buying a machine worth of 10 million naira, the government can be like, okay, on this machine that you bought of 10 million naira, you are meant to be paying tax of 2 million every year. Let's say, for example, okay, you bought it 10 million naira. Okay, instead of you to pay tax of 2 million, you'll be paying 1 million. So government has relieved me of the money I paid to buy this asset. Do you get that illustration? So depreciation Since government has relieved me of the amount I used to pay that asset, which is capital allowance, depreciation should not be allowed, because on this asset that is depreciating, we have already allowed you, giving you an allowance, and that is capital allowance. So that is why anytime we are dealing with disallowable expenses, we subtract, we include depreciation in disallowable expenses, because why? An allowance, a capital allowance, has been granted already. So that's another example of let's see another example here. Yes, another good one is general provisions. General provisions, yes, as times goes on, you will get familiarized with all these um expenses, but I'm just stating the major ones now. What do I mean by general provisions? General provisions are just like, provision for bad debt is the one you feel like, okay, oh, these debts, they cannot, my customers cannot pay. My customers are owing me 100,000 naira, and with the look of things, they can only pay 80,000 naira. So I need to make a provision. That's provision for bad debt. But general provision is just like, let me just make a provision just in case. Nothing, you're not really making the provision for anything. You're just like, just in case they did not pay, or just in case I lost money, or just in, so that provision, general provision, is not for a specific reason. That is why it is not allowed. I hope you are getting it. So we only allow provisions that other provisions are allowed. Yes, provision for bad debt, provision for doubtful debt, provision for discount on debtors, they are all allowed. But general provision is just like, it's a general, like, now let me just make, you're just making provisions for nothing. Like, that is what general provision means. So that is why it is not allowed. So another one we have here is rent disallowed. Rent disallowed. Or rent, yes. I told you that rent is an allowable expenses, right? But imagine you were given the question that the company rented an apartment in a particular place, and they are not using the apartment for production. Yeah, the only rent we allow are the rents that are being paid for the purpose of production to take place on that rented place. So if I'm renting this area now and production is not taking place, and I'm charging the rent on my profit or whatever in my company, it will not be allowed. So you just have to look at, this is the major ones that you will see. Trust me, in fact, these three, they are the major ones you will see. But you just have to look at the question very well. Ask yourself, if these expenses is not incurred, will it affect production? If it will not affect production, then disallow it. But if it affect production, allow it. So these are the major ones. Now let's move to non-taxable income. That is why I said, that's why you need to take note of this wholly. That means expenses are wholly, they are reasonably incurred. Yes, they are exclusively incurred, and they are necessarily incurred for production to take place. So this, any expenses that fit in for these things, then you see they are allowable expenses. So let's go to non-taxable income. What do you mean by non-taxable income? Non-taxable income, I've explained earlier, are income that they are not allowed for, they are not to be taxed. And a good example of those income, let me see what I have here. I have, okay, let me explain briefly. On non-taxable income, there's not really much explanation, much examples, but I'll explain. Non-taxable income, as a company, when you are producing, when you are selling, your income should come from whatever you are producing. Yeah, my revenue should come from whatever I'm selling, then I will remove my expenses so that I will get my net profits. So but any income that is not coming from my production, that is coming from outside, is not an income that will be taxed. Why? Because it's not wholly, it's not reasonably, it's not exclusive, it's not necessarily generated, because these are incomes that are outside production. So any income that are outside production for the firm, we call them non-taxable income. An example of what I have here is, we have let's say, for example, now I own a car, I'm part of the owners of a company, then I have another source of income, personal investment. Yes, I invested in another companies, and the money I earn from that company is 100 million. That 100 million will not be taxed. It will be taxed on my own account. probably as my personal income tax. But in the company, we are only concerned with income that are generated from production. Any other income is a non-taxable income. So I hope you understand non-taxable income and disallowable expenses. As we solve question further, you will get it more. So another thing that we mention before we move to start solving question is what we call capital allowance. Yeah, that is why you need to watch my video on capital allowance. I've explained capital allowance there. And instead of allowing depreciation, rather we allow capital allowance. And what is capital allowance means? Capital allowance is just like, a relief whenever a company is buying an asset, a fixed asset. Government relieve them. Now, what did I want to say, or why did I want to mention this capital allowance? You see, the percentage for capital allowance must not exceed 66 O number 2/3%. Now, what am I trying to say? Whenever companies buy fixed assets, government allow them, okay, instead of you paying 2 million because you buy these assets, we'll be relieving you 1 million for the next 10 years, so that we'll be able to relieve you up to the amount of that asset you bought. But if, for example, now a company is generating 10 million naira profits, 10 million naira taxable profits, and the capital allowance, for example, capital allowance that has been computed is 94,800,000. So I hope you are following. A company makes a profit of 10 million naira, or taxable profit of 10 million naira, and the capital allowance that has been computed is 9,480,000. Let's put it like that. 9,480,000. That means that any capital allowance you want to grant any company should not exceed 66 O number 2/3% of the taxable income. So if I want to grant capital allowance now, this 66 O number 2/3, if you convert it, 66 O number 2/3 divided by 100, you have 2/3. That means that whatever relief capital allowance you want to grant any company must not exceed two-thirds of the taxable profits, or taxable income rather. So 2/3 of 10 million naira, that's 6,666,666 million. Yeah, that is 6,000,000. Let's say 6,666. Yes, 666 naira. So that means that instead of me to grant this company, though their capital allowance that we want to grant them is 9,480,000, but instead of me to grant them this 9 million, I cannot grant them a capital allowance that exceeds 66 number 2/3. So I will only grant them this. So I will now say 10 million naira minus 6,666,666 naira, 666,000. So we have, if I subtract this from this, I will have 3,333,334. So instead of me to grant this company 9,480 something thousand allowance, rather I will grant them 6,666,666 naira allowance. Why? Because according to provisions, capital allowance that is being granted in 1 year of assessments must not exceed 66 O number 2/3%, which is the same thing as 2/3. So that is the major things I feel you need to know before we start taking questions on capital allowance. Let's take one question and let's solve together. Let's see how a real life question will look like. So let's take a look at this question. We have Halaron Limited, an agro-allied company, has been in business for several years and makes up its account to 31st October annually. The account for the year ended 31st October 2018 show the following. So the profit for the year is 130,000. After charging the profit of the year is 130,000. After charging depreciation, which is 50,000, bad debt including provisions, sorry, including general provisions, which is 20,000, donations, including 10,000 to a social club, 12,000, cash stolen in transit, 5,000, interest received, 2,000, court fines, 3,000, profit on disposal of fixed assets, 110,000. So we are required to show the company's adjusted profit for tax computation. Yes. So this is a very simple question, and I like this question. It encompasses everything I've actually talked about. So the name of the company is Alaron Limited. Alaron Limited. So the next thing we need to write after stating the name of the company is to state the year of assessment. Now, if you look at this question, they said the account for the year 31st October 2018, and I told you guys that in company income tax we use preceding year basis. That is that this tax of 2018, this account is for 2018, and the tax will be computed in 2019. So computation of CIT, computation of company income tax for 2019 year of assessment. So the year of assessment is very, very important. That's why if you have not watched my video on basis of assessment, please do well to watch it. I will drop the link under this video. So the first thing we are given is the profit for the year. So we start also, our profit for the year is 130,000. That's our profit. But we arrive at this profit after charging all these expenses that was listed. The first one is depreciation. You know that depreciation is a disallowable expenses. I've already explained, it's a disallowable expense. So what are we going to do? We are going to add disallowable expenses because they have reduced the profits, so we add them back. So let's do add disallowable expenses. Disallowable expenses, which are depreciation. My depreciation from this question is 50,000. 50,000. So we have bad debt, but if you look at the bad debt, they tell us that bad debt is 20,000 naira. But out of that 20,000 naira, 10,000 of it was a general provision, because they said bad debt including general provision of 10,000 naira. So I need to add that back because I already explained that general provision is a disallowable expenses. General provision of 10,000 naira. So after that we have donations. Yeah, if you look at this donation, they said donations is actually 12,000 naira, but we donated 10,000 to a social club that we don't know. Do you get it? The real donation amount is 12,000 naira. 2,000 was for a recognized non-governmental organization or anything you want to call it, but 10,000 is for a social club that we don't know. We're not told the name. So what do? We add it back because it's not wholly, reasonably, exclusively, and necessarily incurred. So we have donations. Donation of how much? Of 10,000 naira. Good. So the next one we are going to have cash stolen in transit. Good. Look at this cash stolen in transit. That's why I said there are some other expenses that will be there that you just have to look at it. That cash stolen in transit, is it wholly, reasonable, exclusively, necessarily incurred? Is it part of production, expenses? No, it's not part of production expenses. Fine, you lost the money, but it is your mismanagement. If you manage the cash very well, you will not lost it. So it is your mismanagement. The tax authority should not bear that loss. You should bear it because you are the one that mismanaged your cash. So it is none of our business. Cash stolen in transit, we are going to add it. So cash stolen, which is how much? 5,000 naira. So I hope you getting it. The next one we have. So we have interest received. Now if you look at this interest received now, okay, it's not an expenses, let's leave it. That interest received is not an income, rather, because it's non-taxable income you are going to subtract. So it's not an income, let's leave it. Court fines, yes, court fines. Court is fining you. Why? We don't know, because court fine is not part of the expenses that are necessary for production. Court is fining you maybe for some whatever reasons, I don't know. So why should it be included in? No, 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 no. So we add it. Court fines. Court fines, which is 3,000 naira. And sorry, so profit on disposal of fixed assets is not an expense. So this, all these are the non-taxable, sorry, disallowable expenses. Sorry. So disallowable expenses. So by the time we take our calculator, we had all this we have on the board. We have 50,000 plus 10,000 plus 10,000 plus 5,000 plus 3,000. We have 78,000. So we had all this together. We have 78,000. 78,000 plus 130,000 plus 130,000. That gives us 208,000. 208,000. Now, the next thing I need to do is to subtract my non-taxable income. So looking at the question, going back to the question, let's look at our income that should not be taxed. Okay, depreciation is an expense, bad debt is an expense, donation is an expense, custody in transit is an expense. But our interest received is not the money or the revenue generated from sales or from producing. So we should not tax it, because I said only revenue you generated or income you generated from sales, anything related to what the company does is what will be taxed. So cash interest received is none of it, with less non-taxable income, which is interest received, which is how much? Interest received is 2,000 naira. And we have, now look at the profit on disposal of fixed assets. Yes, what the company sell might be baby food or phones, but they are selling their assets and they are making a profit. Maybe they are selling their machinery or something. That is not part of what they sell. That is not part of what the company sells. That is not part of the goods the company produce. So profit on disposal is a non-taxable income also, because we are only dealing with the income that comes from what the company sells, and profit from disposal of fixed assets is not part of it. So we are going to add that also as our non-taxable income. Profit on disposal, which is how much? 110,000. So 110,000 plus 2,000 will give us 112,000. So we subtract this from 208,000. So 208,000 minus 112, that will give us 96. That will give us 96,000 exactly. So give us 96,000. So this 96,000 is the taxable income. Yes. So now from this 96,000 naira now, but in this question, we are only told to compute the taxable income, the income that will be taxed. This is the income that will be taxed. Having been the question has informed us that this company is a large company, is a small company or a medium company. If it's a large company, from this 96,000, you now apply your tax rate, which is 30%. So 30% of 96,000 will be the tax this company will be paying. I think it's a large company. If it's a medium company, 20% of it will be the tax this company will be paying. So as simple as that, that is how to compute company income tax. But let's take a question that is quite different from this form, and let's see also. So the second question we'll be solving goes thus. Bojo Limited is a foreign company involved in air transportation business. Its aircraft is used for cargo and passengers flights between Nigeria and Italy. The audited financial statement for year ended 31st December 2015 reviewed the following. So we have Income from passengers flown from Greece to Nigeria, you have it to be 6,638,638,400. Income from passengers flown from Nigeria to Greece as 5,095,875. You have income from cargo loaded into aircraft on other routes, 3,390,000, and income from cargo freight from Nigeria to Greece, 5,062,500. So everything is 20,186,775. So we have the operating expenses that they incurred for them to generate all this revenue. So we have operating expenses, which is depreciation 690,000, staff salaries 1,087,500, use of airport facilities 130,500, accommodation for airline crew 42,750, hotel bills for passengers 180,000, general provisions 52,500, and their profit is 18,003,525 naira. So what they asked us to compute, we're told to budget Nigeria. Okay. Oh, so we are told to compute the company income tax for this year. So sorry, that is not all for the question. So the question goes was, in addition to the above capital allowances, in addition to the above, capital allowances were agreed with the relevant tax authority as 175% of depreciation. So you are required to compute the income tax liability for assessment for year 2016. So that is a kind of clumsy question, but we are going to solve it. Please, if you don't understand the question, take your time to scroll back and read the question all over again so that you get a broader understanding. But one thing I need to explain before we solve this question together is that, you see, this question is an airplane company, right, that fly people from Nigeria to between Nigeria and Egypt. But I want you to know that only income that are being generated from Nigeria are taxed. Any income or any revenue coming from outside the country to Nigeria is not being taxed. So only income that are generated within Nigeria, because we can't be taxing income that is being generated in Italy. Yeah, is that income is meant for Italy country and not Nigeria. So only income that are being generated in Nigeria are being taxed. But if you look at this question very, very well, out of all the income that have been generated, it's only two that have been generated from Nigeria, and that's income from passengers flown from Nigeria to Greece, 5,095,875, and income from cargo freight from Nigeria to Greece, 5,062,500. These two income are the ones that have been earned from Nigeria, because you are flying people from Nigeria to Greece. So you are flying Nigerians. That is Nigerian money. You are flying Nigerian to Greece. So it is those income that will be taxed. So let's go. Bogjo Limited. We have Bogjo Limited. Bogjo Limited. And we want to prepare company income tax. For now, this books of accounts is for 2015. So 2016 year of assessment. I already told you preceding year basis. So the first thing we need to do is to get the revenue that is now in this situation. Now it's not the profit that we have been given, we have been given the revenue. The revenue, the difference between revenue and profit is that in revenue, expenses have not been subtracted, but in profit, expenses have been subtracted. So now the revenue for Nigeria is 2, and that is income from passengers from Nigeria to Greece, which is 5,095,875, 5,095,875, plus the one from income from cargo freight from Nigeria to Greece, which is 5,062,500. So 5,062,500. So if I add these two, I will get the income that has been generated from Nigeria. So let's add it together. So if you add these two together, it will give 10,158,6,375 rather. So if you add these two together, 10,158,375 naira. 158,158, yes, 375. So we don't need this anymore. So the only income we want to reckon with is the one earned from Nigeria, and when we add it up, that is what we get. So now the next thing we need to do is to deduct our allowable expenses, because this is the revenue. Allowable expenses has not been deducted, so we need to deduct our allowable expenses. So less allowable expenses, allowable expenses. So the allowable expenses will be, now depreciation is not part of the allowable expenses. You already know that depreciation is not part of it. So but the allowable expenses, we have staff salaries, which is 1,087,500. We have use of airport facilities, from the question also, which is 130,500. We have accommodation. If you see, all these expenses are incurred for flights to be able to take place, 42,750. And what again? Hotel bills for passengers, for passengers, which is 180,000. And the last one, general provision. You already know general provision is not an allowable expenses. So these are the allowable expenses. But I want you guys to take note of something. And what is that? All these expenses that are listed here are for Nigeria, are for not only Nigeria. All these expenses are not only for Nigeria, because we have 4 revenues that are being earned. All right, that's income from passenger flown from Greece to Nigeria, income from passenger flown from Nigeria to Greece. So the one that is very, very important, or the income earned from Nigeria, is just 2 out of 4. So for the whole 4 income we earned, we incurred all these expenses for the whole 4 income. So, and only 2 belongs to Nigeria. So it will be so very, very, very irrational for me to not charge all the expenses for 4 source of income. I should not charge it on 2. So what did I have to do? I need to prorate. And how do I prorate? Let's do, the first thing we need to do is to firstly add all these expenses. Let's go. So if you add all this together, it will give you 1,440,750. So all this 1,440,750. That is what it will give you. So this is the total expenses for 4 sources of income, and it's only 2 sources of income I want to reckon with. So if you want to share it, so this total expenses for 4 sources of income over the total revenue, total expenses over the total revenue. Now if you go back to the question, we are told that it's even in the question already, they added all the revenue together, and the total of the revenue is 20,186,775. 20,186,775 multiplied by the revenue generated in Nigeria. So the revenue, total expenses divided by the total revenue times the revenue generated in Nigeria will give you the expenses, the amount of expenses incurred for Nigeria alone. So times 10 million times 10,158,375. So if we do this, what are we going to get? Let's take by my calculator here. 10 million, 1,440,000 divided by 2 million, 20,186,775. That will give me 725,013. So for Nigeria alone, all this we give for Nigeria alone will give me 725,013. Yeah, you can show this calculation that you did, you can show it here in case of exams, or you show it in the workings. Show it in the workings so that the examiner can know that yes, you know what you are doing. So this is the total expenses for Nigeria, for what is incurred in Nigeria. So what do I need to do? We also told in the question, or firstly we can get our let's subtract this from this. So we have 10,158,375 minus 725 and 13. I'll get 9,433,362. 9,433,362. 9,433,362. Now from this 9,433,362, they said something in the question. They said that the capital allowance should be 175% of depreciation. I still remember. Let's check it out in the question. So in addition to the above, capital allowance we agreed with the relevant tax authority as 175% of depreciation. So capital allowance, let's calculate our capital allowance. Capital allowance is 175%. That's 175 divided by 100 times the amount of depreciation. And what is the amount of depreciation from our question? The amount of depreciation is 690,000. 690,000. So 175% of 690,000. What are we going to get? 175 divided by 100 times 690,000. That's 1,207,500. 1 million capital allowance. Capital allowance is 1,207,500. So this is my capital allowance. So the question is that let's see if this my capital allowance does not exceed 2/3 of my income. Yes, if you take 2/3 of 9 million, let's do that, because I already said it that your capital allowance must not exceed 2/3 of this your taxable income, and this is my taxable income. So 2/3, 2/3 of 9,433,362. That's 6,288,000, and our capital allowance is not even up to that. So we are free. We can continue our computation. So to get the income we are now going to tax, we need to subtract our capital allowance from our income. So subtract this from this. What will that give us? So we have 9,433,362 minus 1,207,500. That'll give us 8,225,862. So 1,225,862. So from this we can now calculate our company income tax, which is, but the question is, what rate are we going to apply? Yeah, from the question you can see that though the revenue generated from Nigeria is 10,158 whatever, but from the question they have given us 000 on top. 000 on top, and when you have 000 on top, that means that it is in, you can still add another 000 to this. So that should be 10,158,000. That is a whole lot of money if you are adding 30 to it. So that should be 30% tax rate. Yeah, so you apply 30% tax rate on this. So company income tax, which is what, at 30% of 30% of our income. That's 30% of 8 million whatever, and that will give us 2,467,758.60.6. So if you charge Company income tax at 30%. The reason we are charging 30% is simple. From the question, they have already given us that these figures there's extra 000, and when you see 000 on top of the question, that means you can see add. I can see add 000 here. That should be 100,583,750 naira, in millions. And if you add 000 is in millions, so you know that that's over 100 million. So they are paying 30%. So 30% of it, this is what it gives. So we've come to the end of the first class on company income tax. Yeah, another class is coming, where we teach how to compute minimum tax, how to estimate company income tax using dividend basis and sales turnover basis and all of that. You don't want to miss it. Please hit the subscription button. I'll see you right away in my next class. Thank you.